Welcome to today's market report.
Both stock markets got their foot back on the gas on Thursday as hopes grew that Washington could resolve its debt ceiling squabbles and a global drop in energy prices tempered deepening fears of stagflation. Europe's bourses rallied off 2.5-month low as easing oil and gas prices offered relief after a shock 4% drop in German industrial production, which highlighted the toxic stagflation risk of runaway inflation and moribund growth. The Pan-European Stock 600 index rose 1.1% in broad-based buying to reverse weekly losses, with miners, utilities and car makers all driving higher. Bond market borrowing costs also calmed after a sharp spike a day earlier that had taken the region's benchmark government yields to their highest point since June. We believe the recent pullback is an opportunity to buy the dip in cyclical assets, which could include all equities, EM and DM, according to JP Morgan, although US tech stocks remain ultra expensive. We do not believe that the current price of energy will have a significant negative impact on the economy, even with oil at $130 or $150 per barrel. Equity markets and the economy could function well, pointing to 2010 to 2015 when oil averaged more than $100 per barrel and markets did just fine. Oil was down more than 2% and gas prices dropped more than 3%, helping European gas futures fall back from record highs. Gas prices are up more than fivefold since the start of the year, and the huge increase over recent weeks has attracted attention from policymakers across the world. EU Energy Commissioner Kadri Simon said on Wednesday that the price shock was hurting our citizens, in particular the most vulnerable households, and that there is no question that we need to take policy measures. Britain's National Grid said the UK faced tight electricity supplies this winter, while local media reported that Spain's energy minister had summoned the top executives of its three main electricity firms. US futures also bounced, with S&P 500 rising 0.5% after wild swings on Wednesday, fueled by hopes that congressional Democrats and Republicans could reach a deal to avert a government debt default. Top US Senate Republican Mitch McConnell said his party would support an extension of the Fed debt ceiling into December. This means President Biden and congressional Democrats would be able to finish their fiscal spending package, now estimated at around $1.9 to $2.2 trillion, said Deutsche. MSCI's broadest index of Asia-Pacific shares outside Japan closed up 1.8% overnight, its biggest one-day rise since August. The yield on benchmark 10-year US Treasury notes was at 1.53% of Wednesday's 3.5-month high of 1.57%. German bonds hovered at a still negative minus 0.19%, and gold dipped 0.2% to $1,759.89 per ounce. On the FX front, the GBP/USD is recovering some of Wednesday's losses, climbs 0.32% near the tops of the week, trading at 136.26 during the New York session. A positive market sentiment surrounds the market, as witnessed by European and US equity markets, rising between 1.46% and 2.09%. Further risk-sensitive currencies like the pound, the Aussie and the Kiwi are advancing. The US debt ceiling solution, although short-term, it was a relief for investors. Additionally, Russia's offer to ease Europe's energy crisis sums up the upbeat tone. In the UK, the Halifax house prices for September edged higher more than the previous reading. On an annual basis, it rose by 7.4%, higher than 4.9% expected, whereas the monthly basis heightened to 1.7%, more than 0.8% estimated. The second out of the three jobs-related report reading was better than expected. The US initial jobless claims increased to 326,000, lower than the 340,000 foreseen by analysts. According to the report, the advanced number for seasonally adjusted insured unemployment during the week ending September 25th was 2,714,000, a decrease of 97,000 from the previous week's revised level. That said, the US labor market seems to be improved, with 2 out of 3 positive reports. The dollar index was trading at 94.10, down 0.14%. Eurodollar faced the initial optimism and shifts the attention back to year-to-date lows and the further south.
This is today's market news. Thanks for listening. We'll see you next time.